On Friday, U.S. stocks snapped a 4-week winning streak when all three indexes closed lower on the session and on the week as a summer rally lost momentum. For the week, the Nasdaq dropped over 2%, the S&P 500 fell 1.2%, and the Dow was down a modest 0.2%. And the biggest story of the week came to a conclusion on Friday as shares of Bed Bath & Beyond crashed, falling 40%. It's now known as Bloodbath & Beyond. Well, as they say, easy come, easy go. But most interestingly, we now have two market indicators that have perfect records. Although I'm not going to go deeply into each, we now have a Heisenberg state for markets where one flawless, 100% accurate indicator suggests the market is set to tumble and hit a new market low, while according to another flawless indicator, it suggests stocks have already bottomed and will now soar. The first indicator is the 50% Fibonacci retracement, essentially a close over 4220 in the S&P 500, which we've now done, has historically indicated it would void the bear market rally thesis, as there has never been a bear market rally that exceeded the 50% Fibonacci and then went on to make new cycle lows. So this indicator says up, up, and away. The other indicator is the rule of 20. And this indicator, with a perfect record, says that the sum of the CPI year over year plus the trailing PE has always been lower than 20 when the market bottomed. So, with the current sum well over 20, this indicator says we have more downside to come. In short, we've reached a perfect quantum state of a market based on flawless, backward-looking indicators where one 100% accurate market signpost predicts a stock market melt-up from here, while another sees stocks tumbling to a new and far more painful low. And now, I'm going to attempt the high-wire act of providing my opinion. And we're now looking at a 20-year monthly chart on the spiders, the SPY, and the close on Friday was 422.14. Now, that's up here at this point, and you can see we had that top there. We came on down here. We reflected, bounced off of the 50 EMA, and then on up to this point here. So, let's go take a look at the oscillators, and I'll give you my opinion. Volume, my opinion, not going to show us too much. But here we have the MAC. This is the problem that I see. We're very high elevated, so there is some strength, but the difference, the separation between the fast line here and the slow line here, in my opinion, that's going to be very, very difficult for the fast line to bottom and base and come on up and through that slow line. I just don't think it has enough strength to do that. That's a big separation. Now, in these previous lows, such as here in early 2020, the government poured money into the market and into people's savings account, and that helped save that market low, and we rocketed. We're in a different time now. We're in a different time than we were in 2019, as well as 2015 and 16. Are we going to reach a low of 2009? We'll have to wait and see. But right now, I just don't think it has the strength, again, to bottom and base and move on up. I don't think it's going to happen. You can see here in the histogram how deep we are. We're at near negative 10. Now, at this point here in 2009, we were only probably at about a negative 7, perhaps negative 8. We're very negative here. I don't think we have the power to move all the way up without another correction coming on down. And if we have another correction, I think there's a good chance that it may test those lows. It may go below those lows, and that would be painful. Here, the the price rate of change from that point there. This is a steep drop off. Boom. You have this fish hook right here. There's still a pretty good separation between the fast line here and the slow line here. It is still above zero, but I still think that that separation means a lot of volatility. Moving here into the relative strength index, boy oh boy, we're weak. We're just barely moving through that 50 or midline, coming from this top up here in that overbought territory above 80. This is extremely weak. And if the MAC, the fast line, is going to make it up and through that slow line, we need a lot more strength here. We need to be back up here in that 80 level, and I don't think we're going to get there. Moving on down here into the stochastics, pretty much the same thing. Notice here, you see this fish hook that happened at this point in time there, and then what happened after that. That's a possibility. I'm not saying it is the probability, but I think it's a possibility, and I just want to be safe. Same thing here in the Williams. Back here in 2008, we had a number of moves on up out here, such as there, but it came back down and crashed, and that was painful. We are back up here to this negative 50 or midline, but that again is not very strong. I think there's a strong possibility that we could move on down. What's the probability? I'm going to give it 50-50. I don't really know. My opinion on this one is I do think that there is a fair chance, probably, let's change my opinion. I think there's a greater chance that we are going to test those market lows. The MAC has a long way to close that separation between the fast line and the slow line. All right, let's see if I'm right. If I'm wrong, send me to the guillotine. And for today, that's ChewDog Charts. Thank you.